right, and welcome back, everyone. I would like to welcome Lorne Steinberg. He's the president of Lorne Steinberg Wealth Management. His firm provides investment counsel services to high net worth individuals based on principles of integrity, transparency, trust, and capital preservation. Mr. Steinberg received his MBA from the Wharton School of the University of Pennsylvania and his BA from McGill University. He's been a chartered financial analyst holder since 1996. So, Lorne, thank you so much for being here. The floor is all yours, sir.
Mark, thank you very much, and good afternoon, everyone. I'm very happy that you could join me this afternoon. This is certainly a little different from last year's Money Show when I had the opportunity to meet with many of you, but I'm really excited to be able to share my thoughts with you today. These are certainly interesting times, as if that's not the understatement of the year. So today I'm going to give you a brief rundown of where we see value in global equities. You need to hold some cash, as we did before COVID. Where we see value in Canadian equities and where we see value in fixed income markets in a zero rate environment. So before as I kind of get going here, it's good to take a big picture view. Clearly, some of the major issues we're dealing with at the top of the list is the pandemic and the very deep global recession that is well underway, ongoing political dysfunction, record high debt levels, consumer, corporate, and government, which are climbing ever higher, geopolitical risk, interest rates, the million-dollar question, or trillion-dollar question today, and always at the top of the list, investment valuation. Of course, we're in the midst of probably the worst global recession since the Depression. And it's not, it's that this recession is probably going to be a pretty long one, moving well into 2021. And that's going to impact a number of industries more than others. And it's really important that investors know where they should be investing and where they shouldn't be. So there's a few cartoons on this page, but clearly some of the major geopolitical risks are the ongoing trade tensions between the two largest economies in the world, the US and China. Brexit is supposed to be resolved by the end of this year, yet the two sides are no further advanced than they were at the beginning of the whole process. And boy, does it feel like we have unstable leadership in so much of the world. And that's having an impact on markets and on trade tensions, and nothing seems to be able to get done from a political standpoint. Last year when I gave this chat, we said interest rates were so low, how much lower could they fall? Answer, they could still fall further. Central banks are buying everything in sight, and that is driving interest rates to these zero levels, negative rates in a lot of the world, and that's putting a lot of pressure on investors who are desperately seeking yield, yet still trying to preserve capital. Not an easy thing to do. This chart that you see here is the VIX. The VIX is a measure of volatility, but it's also colloquially known as the fear index. And as behavioral finance professionals have shown, investors have a far greater fear of losing money than the elation they feel when they make money. Emotion is very, very strong. And investors tend to make emotional decisions in times of uncertainty instead of acting rationally. And I'll tell you, emotional decisions can be so destructive to long-term wealth management, as we're about to see. So Fidelity did a study of what individual investors, how they behaved as COVID unfolded between February 20th and May 15th of this year. And shockingly, over 30% of investors over the age of 65 sold all of their equities, everything. Clearly, we know this was not the correct approach, but when fear takes over, it's so hard to fight. And one of the big messages is that wealth isn't always created or destroyed just by investment performance. It's far more destroyed and created by investor behavior. And so you might ask yourself, if this is what individual investors were doing as COVID unfolded, Lorne, what were you up to? Well, last year we mentioned that we had been building a cash position. And by the time we hit February of this year, we were sitting with about 30% cash. And so as COVID unfolded and investors were looking into a black hole and stocks were going down every day, we did exactly what our clients expected us to do, because we had a chance to buy some of the world's great businesses, some of which you see here, when they were on sale. And so for us, that was an opportunity to buy Alphabet, which is Google, Alibaba, Visa, Unilever, Disney, Diageo, the largest spirits company in the world. And as a number of clients said, Lorne, I think they'll do pretty well because all I want to do is get myself a drink these days. And so the message is not that we knew that the markets were going to rebound quickly, and who knows what will happen going forward, but at the prices we were able to buy these stocks at, we think we have great upside over the next 5 years. So a lot of investors are scared of volatility. But to investors such as ourselves, volatility is great because it always leads to opportunity, as long as you are prepared. The key is to make sure you have a good captain and the right strategy. And value investing is all about remembering that trees never grow to the sky. In this business, nothing ever stays cheap forever, and nothing ever stays expensive forever. So as stocks are climbing, it's usually a time to start paring back and raising some cash so that you're able to take advantage of those great opportunities. Because as we like to say, the only happy investor when the market falls is the investor who has cash to spend. So we have a great research team, and we spend our time looking for great businesses, figuring out what is their fair value, what price is cheap enough for us to buy it where we still have a margin of safety. Of course, we're looking globally, and we're very focused on making investments that are going to generate absolute returns. We need to make money for our clients, so we're not going to be in business. And we look for stocks in many different ways, screening for ideas, using analytics and the like. And on this inverted triangle at the bottom, you'll see one of the keys to successful investment management, which is monitoring. We have to monitor our investments because unfortunately, not every company we invest in is going to necessarily behave the way we thought it was going to. And the anecdote I always like to tell is one of the best investments we made during the financial crisis, that no client would ever pat us on the back for, but it was a great decision. We had purchased Citigroup as the financial crisis was unfolding and paid about $42 per share. About 3 months later, a pretty short time, Citigroup had fallen 25% to $32 a share when they released their first quarter filing. Now, normally, if we liked it at 42, we love it at 32, and so we'd be adding to it. But in Citigroup's first quarter filing, they divulged the fact that they had about $500 billion of off-balance sheet liabilities that no one could really understand, and in retrospect, their management team didn't even understand it. So knowing that this now existed, forgetting about the price we paid for Citigroup, I looked around the research table and said, okay, knowing this, which one of you would like to add to Citigroup? Down 25%. No one raised their hand. And the message is, as professional investors, if we don't want to add to a stock that has gone down 25%, it's probably because something has gone wrong with this business. And so we sold Citigroup and took a 25% haircut just 3 months after we'd first purchased it. And after we sold it, as the financial crisis unfolded, Citigroup fell another 90%, and it's never recovered after the reverse stock split that they did. And so avoiding a 90% further loss was just as valuable to the portfolio as buying a stock that doubled. So unfortunately for us, no client ever said, Lorne, great job, but we are proud of that decision because professional investors should never hold a stock based on hope. Hope is not a good strategy. So what is value investing and how do we see value? Value investing means 100 different things to 100 different people. But for us, it starts off by buying great businesses that have great balance sheets. They're financially very strong. And that usually means they have little or no debt, and all of them generate what we call free cash flow. That is simply they all make more money than they need. Every study has shown over the last so many years that those companies which generate free cash flow are able to create shareholder value because they can use their excess cash to pay down debt, make acquisitions, buy back shares, and increase dividends, all of which, if done well, are accretive to shareholder value. And most importantly, we need to buy these great businesses at a price that makes sense, where we have a margin of safety and plenty of upside. I decided to give you a couple of stocks that are in our portfolio, which have very different metrics, but which are both great values. One is Cisco, the great IT company, which is the leader in the world in IT security, a very important area today. Cisco is actually a pretty mature business, fairly low growth. Revenues are growing in the low single digits, and earnings growing in the mid to high single digits. We compare that with Alphabet, which is Google. A great growth story, revenues and earnings growing in the double digits, and we expect they'll grow at that rate for quite some time to come. Yet at the prices these shares trade at, for us, both of them have a great margin of safety and offer roughly the same upside over the next 5 years. So despite the fact that one is lower growth and one is higher growth, both of these stocks qualify as great value investments, and we hold both of them in our portfolio today. So value means many different things. And as we like to say, value investing is rarely comfortable, but boy, is it profitable. Here are 10 stocks that we hold in our portfolio. Most of the names you will recognize. The price we paid is the price we first bought these shares at. And the middle number is the 5-year high at the time we purchased these shares. So if you look to the bottom, you'll see that when we bought Allstate at $24 per share, it had fallen from a high of $62. Same thing for even Microsoft. It had fallen from 36 to 26. So it's the job of the research team, because stocks always fall for a reason, to figure out, did these stocks fall for some reason that is permanent and these companies are impaired, or is this just something temporary? An example of something more permanent might be the retail sector, where yes, a lot of great retailers have had their shares fall, but for good reason. So we judged that all of these companies had fallen for temporary reasons and represented great value, although let me say that just because a stock is cheap doesn't mean it can't get cheaper. So 8 of the companies on this page, after we first purchased them at the prices you see, the shares fell another 20% and we added to those positions. And if we've done our research right, the results are shown on the far right, the price today. A little bit of patience and allowing good management to do its job results in value creation for our clients. The message is there are lots of great companies in this world, but a great company is only a great investment if we can buy it at a great price. So up until recently, one of the regions we avoided investing in was Canada. However, a few months ago, we shifted gears and said Canada today offers some great opportunities for investing. So the question is, Lorne, after all this time, why Canada and why now? Well, first of all, the Canadian stock market has been one of the worst performing markets since the financial crisis and underperformed most other markets during that time. Part of the reason is that foreign investors have always seen Canada as an energy dependent economy, and that is still true, although less so than it was 10 years ago. And given this underperformance over such a long period of time, many sectors in Canada now offer excellent value and very high dividend yields. So we decided to start very recently our Canadian Dividend Growth Fund. As always, we're focused only on owning the best of the best. Great companies that are very strong financially, businesses with strong moats, meaning it's hard to compete with them, and sustainable and growing dividends. So one thing about Canada, we have two industries which are oligopolies, our banks and our telcos. All of you who have a cell phone are probably well aware that as Canadians, we pay some of the highest wireless rates in the world. And we all deal with banks, and we're basically stuck with a few large banks. As I like to say, I'm not always crazy about being a customer of our banks and telcos, but I sure love being an owner because these companies have been able to deliver great earnings growth, very strong dividend growth. Dollarama is on this page, even though we don't own any retailers globally. Dollarama is one of the few retailers in the world that has no overlap with Amazon. No one ever walks into a Dollarama store, says, hey, this item is $2. Let me go home and check it on Amazon before I buy it. So they're in a pretty unique situation. So in our Canadian Dividend Fund, we've got a great group of businesses with really strong moats around them. And we're getting a dividend yield that is already above 4%, with dividends that we expect to be growing over time. But as important as it is to focus on what area of the market we want to be invested in, it's just as important to look at what areas we don't want to be invested in to avoid mistakes. And in Canada, we've avoided oil producers, metals producers, and REITs. First of all, resource companies have been terrible, terrible creators of shareholder value. Many of them are trading where they were 10 or 20 years ago. Also, they've done a pretty lousy job on dividends. Yes, they probably pay too much when times are good, and then they're forced to cut them when times are bad. We expect to see in the oil sector just about the entire sector being forced to cut dividends over the next 12 months. Now, a number of clients approached us when the REIT stock started to fall after COVID and congratulated us for not having REITs in a dividend fund. Pretty rare. Well, of course, the reason is, first of all, no, we did not anticipate COVID. But as I mentioned in last year's Money Show, the yields on REITs in Canada were so low, there was no margin of safety. They were basically trading on a price for perfection. And so there was no value there. And now as we look forward, as businesses will probably be using less office space over the next many years, as mall traffic will continue to slow, we still don't find value in the REIT sector yet, despite the haircut that investors have taken. So important to focus on not just what is attractive, but to avoid what we call value traps. And finally, I'll spend a few minutes talking about fixed income, since most investors have some balance to their portfolio. The chart that you see in front of you is probably no surprise to any of you. The red bar is government bond yields. And in Canada and the US and most of the world, government bond yields are close to zero, less than half of 1%, which is way below the inflation rate. So there is no value whatsoever buying basically zero yielding government bonds or things like Royal Bank bonds. Interestingly enough, a number of Canadians have invested in balanced mutual funds. And one thing these investors need to be aware of, in a balanced fund, maybe 40 to 50% of the assets are invested in government bonds and related bonds with very low yields. And those yields today are actually lower than the fee that you're paying in your balanced fund. So owning a balanced fund cannot make any sense today because on half your portfolio, you're not even earning your fee. The reality is most fixed income today no longer covers inflation and is just not a place to be for investors. So if you're a fixed income investor, is there any value at all? The answer is there is still one place where we do find great value, and that is the high yield corporate bond market. As you can see on this chart, high yield corporate bonds still yield over 7%, which is way above the yield that one can get in other types of fixed income. And certainly, preferred shareholders have learned that preferred shares in Canada are not fixed income and have been a pretty rough place to be and have certainly not been, the yield's not been fixed, and they sure haven't preserved capital. So when a lot of investors hear about high yield corporate bonds, they start to worry, are these really risky companies? The reality is many investors would be surprised that a number of the bonds in our high yield fund are companies that can be found in the S&P 500. Now, I don't know about your family, but I do know about mine, that since COVID hit, our hours of Netflix watching have certainly increased, and many people know, hey, Netflix has been a home run as a stock. Well, believe it or not, Netflix is also to be found in our high yield fund. So why would Netflix or SiriusXM or Post Serials, why would these companies be paying yields that are way above government bonds? The reason is very simple. These companies have large growth in front of them and are very happy to borrow money at higher rates because they can earn a lot more as they grow their businesses. And so these companies and many other very great, sound, strong businesses are in our well-diversified high yield fund, where the team has done a fantastic job at finding these gems, monitoring them well. These are cash flow generators. And it's companies like this in our high yield bond fund that have allowed us to earn great returns over time and going forward. So I've tried to hit on a few key points during my chat. We're finding still some great values in global equities, but it's so important to remember that if stocks get too expensive, you'd better raise some cash. In Canada, we built a great portfolio with a 4% plus dividend yield while avoiding REITs, energy, and metals. And as I say to clients, even if our Canadian stocks don't go up for the next 10 years, you're going to have a 4% plus dividend yield today that will be rising over time. And in this environment, that's already a pretty good return. What a margin of safety. And in fixed income, the only opportunity left is in the high yield corporate bond market. Just like equities, as long as investors can handle a little bit of volatility, there are great opportunities to be had. Now, let me say I work with a great team of people, some of whom you see here. I promise you these are all a diverse group of people with diverse personalities, some stronger than others. But we all share a core set of values, and we also share one more thing. Everyone in our firm has to have 100% of our own investments invested right alongside our clients. So neither me nor anyone else in our firm can buy any other stock or bond except what our clients own. So we all are invested right alongside you and share exactly the same portfolio and end up with exactly the same performance. And that's the way we want it to be. So I encourage all of you to visit our virtual booth, where you'll be able to download our most recent research letters, podcasts, and videos, all of which will give you a really good insight into how we've been able to create wealth for our clients over these many years. And for those of you whom would like to speak with us, to ask any questions you may have, to get a retirement analysis or a comprehensive portfolio review, please go to our virtual booth and complete the online form to book your meeting or your call, because we'd love to speak with you, we'd love to connect with you, and really look forward to speaking with you. Thank you. And if there's any questions, I'd love to answer them.
All right, Lorne, thank you so much for that presentation. Fantastic. We do have a couple of questions coming in. One was just in reference to the metals and mining. They were just curious on why to avoid those.
Sure, because it's funny, when you look at a lot of the metals and mining stocks over the last 30 years, one has to have a long-term time horizon. Yes, if you bought them at the low and sold them at the high, you would have made money. But over a long period of time, they've not done a good job, for the most part, almost all of them, at generating returns for shareholders, at paying consistent dividends. You would have done way better owning things like banks and telcos and not have to worry about commodity prices.
All right, thank you for that. Another question, they were wondering if you own Apple and what are your thoughts on Tesla?
Sure, so let me address Tesla first. Tesla's done an amazing job. Elon Musk is a genius. They were first out of the gate with an electric car. Everyone who drives a Tesla tells me they love their Tesla. The reason we don't own Tesla is twofold. One is the valuation is through the roof. It certainly does not for us offer value. But the second reason is critical. Over the next 3 or 4 years, every car company in the world will be coming out with a slew of electric car models. And suddenly Tesla will not be the only game in town. All of these other manufacturers, from Toyota, Subaru, Nissan, GM, and the like, all have much better distribution than Tesla. And suddenly it's going to be a very crowded field. Margins will be coming down, and we just don't think there's value in Tesla. Do we own Apple? I'd say no and yes. No, we don't own Apple directly. About half of Apple's earnings still come from the iPhone. But we recently purchased our first share of Berkshire Hathaway, my hero Warren Buffett. Berkshire Hathaway shares, as many of you may have known, have lagged for the last few years. And Berkshire has a major investment in Apple, so we do own some Apple through Berkshire Hathaway.
All right, excellent, thank you. Another question, let's see here. They're wondering, are there still opportunities in preferred shares for income?
So most of the preferred shares in Canada are rate reset preferred shares, which means you're very dependent on what happens to Government of Canada 5-year bond yields. As we look forward, because those preferred share dividends are going to be reset over time. So we think there's a fair chance that bond yields may continue to come down for a while, which means the dividends will come down. And we would certainly recommend avoiding preferred shares, as there's just way too much risk, as investors have experienced.
All right, thank you. Another attendee, they're wondering, what are your thoughts on residential REITs, so apartments?
So we've spoken to the major apartment REITs recently. Let me be clear, we've owned apartment REITs in the past. Apartment REITs are telling us that they're experiencing pricing pressure. They expect rents to come down for a couple of reasons. One is Airbnb. Anyone who's got condos that they were renting on Airbnb is now stuck with no travel going on. So a lot of those condos are coming back onto the market, and those condo owners are now trying to rent them out for the long term. At the same time, in the major cities in Canada, foreign students have been a huge renter of apartments. And with online schooling, online university happening in September, a lot of those people won't be coming here, nor will a lot of other people who come to Canada. And so the major apartment REITs are telling us that they're already anticipating and they're already experiencing pressure on pricing. And so lower rents, greater vacancies, we may have an opportunity, but we think it's too early.
All right, Lorne, brilliant presentation today. Thank you for your insights. We definitely look forward to hearing from you again.
Thank you so much for having me. Thanks to everybody, and thanks to so many of our great clients who are here as well.